The story of the greatest investors of all time begins long before Wall Street became a symbol of ambition, wealth, and global financial power. It begins in times when investing was not yet a profession, when people who studied markets were considered eccentric, mysterious, or even reckless. And yet, throughout history, a handful of extraordinary minds discovered something hidden beneath the surface of markets: patterns, behaviors, psychology, and opportunities invisible to the average observer. These men and women changed not only the world of finance, but the way humanity thinks about risk, value, and the future. To understand the greatest investors is not to study wealth. It is to study how wealth is created, destroyed, protected, and multiplied across generations. It is to see how ideas shape markets, how decisions ripple across continents, and how a single individual, equipped with clarity and discipline, can transform the financial trajectory of nations. Our journey begins in the early 20th century, when the modern financial system was taking shape. The world was recovering from wars, currencies were unstable, and stock markets were young, unpredictable, and unregulated. It was in this era that one of the most influential figures in investment history emerged: Benjamin Graham, the father of value investing. Graham did not simply invest. He invented an entirely new way of thinking about investing. He introduced logic into chaos, structure into speculation, discipline into emotional markets. He asked a question that defined investing for the next century: what is this business actually worth, regardless of its stock price today? Graham's early life was marked by hardship. Growing up in New York, his family lost everything in the panic of 1907. It was this personal tragedy that taught him a lesson that would shape his career. Markets can collapse without warning, but those who understand value can survive storms that destroy others. When he entered Wall Street as a young analyst, he quickly realized that most investors were guided by excitement and fear, not analysis. He saw an opportunity, not to gamble, but to create a system that would reward rational thought. When he later wrote Security Analysis and The Intelligent Investor, he crystallized decades of experience into principles that would influence generations. Decades later, a young man from Omaha named Warren Buffett would discover Graham's ideas, and the course of financial history would change forever. Buffett was captivated by the concept of buying $1 worth of value for 50 cents. He traveled to Columbia University specifically to learn from Graham, absorbing every lesson with intensity and devotion. Buffett would go on to become Graham's greatest student and the most successful investor the world has ever known. His partnership strategies, his disciplined focus on moats, leadership quality, and long-term thinking would generate one of the most extraordinary compounding records in human history. The name Berkshire Hathaway would become synonymous with patience, clarity, and the kind of financial wisdom that only comes from decades of trial and discipline. While Buffett dominated the world of long-term value, another investor was rising in a completely different dimension. Peter Lynch, the master of growth investing and the legendary manager of the Fidelity Magellan Fund. Lynch's approach was simple, yet revolutionary. Invest in what you understand. He believed that ordinary people often encountered great companies before Wall Street analysts even noticed them. Lynch would return an astonishing 29% per year for over a decade, turning Magellan into the best-performing mutual fund of its era. He taught investors that opportunities exist everywhere: shopping malls, neighborhood stores, consumer habits, and that curiosity was a powerful financial tool. Then there was Philip Fisher, whose ideas shaped the philosophy of investing and innovation. Fisher believed in studying the quality of a business long before the market recognized its potential. His idea of scuttlebutt, gathering information from employees, suppliers, and competitors, redefined how deep research could go. Fisher gave the world a new vision: invest in companies not for what they are today, but for what they are becoming. His influence can be seen even today in the playbook of Silicon Valley and in the strategies of modern tech investors. But investment history is not only the story of value and growth. It is also the story of risk, cycles, and macro forces. Enter Ray Dalio, one of the most influential thinkers in global finance. Dalio approached investing like a scientist, building systematic models that studied how economies functioned. He believed that markets moved in predictable cycles driven by human behavior, debt, productivity, and monetary forces. His firm, Bridgewater Associates, became the world's largest hedge fund, managing money for governments, central banks, and institutions. Dalio's discovery of principles, his commitment to radical transparency, and his ability to anticipate economic crises made him a central figure in the study of global markets. There's also George Soros, a man whose name became a symbol of both brilliance and controversy. Soros' theory of reflexivity, his belief that markets influence fundamentals and vice versa, gave him an edge that few could understand. He became one of the greatest macro traders in history, famously breaking the Bank of England in 1992 by betting against the British pound. Soros's courage, intuition, and deep understanding of global politics made him unique among investors. He did not simply trade numbers, he traded ideas, trends, and the psychology of nations. From macro thinkers to quantitative pioneers, the world of investing expanded further with figures like Jim Simons, the most mysterious and mathematically gifted investor of all. A former codebreaker and mathematician, Simons used complex algorithms to uncover hidden patterns in markets. His fund, Renaissance Technologies, created one of the most profitable trading systems ever built, generating returns that exceeded anything seen before in modern finance. Simons proved that markets were not random. They contained secrets that only advanced mathematics could uncover. Another transformative figure was John Templeton, the pioneer of global investing. At a time when most American investors focused solely on domestic stocks, Templeton traveled the world searching for undervalued opportunities. His philosophy was based on optimism, discipline, and the belief that no matter where or when, human progress would create long-term growth. Templeton's global vision reshaped the world of international investing and expanded the horizons of countless investors. These are only a few of the giants whose stories shape the world of finance. Yet behind every great investor lies something more than strategy. There are personal struggles, failures, doubts, and breakthroughs. There are moments when the world collapses, when markets panic, when fortune turns against them, and yet they persist. They learn, they adapt, they rise. The greatest investors of all time are united by something far deeper than intelligence. They are united by resilience. They have endured wars, depressions, political upheavals, inflationary spirals, bubbles, crashes, and technological revolutions. They have seen fortunes made and lost in days. They have experienced criticism, failure, and the loneliness that accompanies unconventional thinking. Yet through all of it, they maintained an unshakable faith in their principles. As we progress through this documentary, we will explore not only their investment strategies, but the emotional and psychological journeys that shaped them. We will uncover how they handled fear, greed, uncertainty, and doubt. We will examine how they built models, philosophies, and systems that stood the test of time. We will reveal the techniques that turned ordinary people into legends and the mistakes that nearly destroyed them. This is the story of the greatest investors of all time, not just as financial icons, but as human beings navigating the unpredictable landscape of markets and destiny. The story of the world's greatest investors moves now into a period defined by transition, an era when markets became more sophisticated, data more abundant, and strategies more diverse. In this chapter, we step into the lives of remarkable individuals who transformed investing from an art practiced by a few into a discipline studied by millions. Their stories are not merely tales of financial triumph. They are chronicles of discipline, patience, intuition, and the relentless pursuit of understanding how money moves through the veins of the global economy. As the 20th century matured, the stock market was no longer an experimental playground. It had become a powerful engine capable of building industries, destroying fortunes, and mapping the trajectory of nations. This was a time when the foundations of modern investing were being poured, foundations shaped by thinkers whose ideas would influence every investor who followed. To understand the modern financial world, one must understand the minds who reshaped it. Among these figures stands one of the most influential thinkers in financial history, Philip Fisher. Unlike the value-focused investors of the generation before him, Fisher brought an entirely new philosophy, one that prioritized growth, innovation, and the future potential of companies rather than their present-day numbers. He believed that great fortunes were built not by purchasing what was cheap, but by identifying extraordinary companies long before the rest of the world recognized their greatness. Fisher searched for what he called scuttlebutt, information gathered not just from financial statements, but from employees, suppliers, competitors, and industry experts. He wanted to understand a company as a living organism, its culture, its leadership, its long-term ambitions. While others were studying balance sheets, Fisher was studying people. While the market obsessed over quarterly earnings, Fisher asked whether the company would still be dominant 20 years later. One of his most legendary investments was in Motorola. Fisher saw not just a manufacturer of electronics, but a company driven by visionaries, pursuing technologies far ahead of their time. His investment grew over decades, not months or years. It was a demonstration of his philosophy that true wealth was created through patience and conviction, traits that set him apart from the short-term mindset that dominates much of the market. Fisher's ideas influenced countless investors, including one who would later become the most famous investor in the world, Warren Buffett. Before Buffett became synonymous with value investing, he absorbed Fisher's teachings and blended them with the principles learned from Benjamin Graham. The result was a hybrid philosophy, part value, part growth, that would define Buffett's unparalleled career. But that chapter 2 is part of a larger story and will unfold later. As investing matured, another brilliant mind emerged, one whose strategies challenged everything the financial world believed. This was the era of John Templeton, a man who refused to accept conventional wisdom. Templeton believed that the best opportunities were found not in comfort and familiarity, but in discomfort and uncertainty. He looked for investments not where others were buying, but where others were afraid to look. In 1939, as the world descended into the chaos of World War II, Templeton made one of the boldest decisions in investing history. He borrowed money and bought shares of every company trading at a low price, companies that the world had all but written off. He believed that fear had driven prices below rational levels, and that humanity's ability to rebuild would ultimately prevail. His portfolio grew into a fortune. This single moment defined his philosophy: invest at the point of maximum pessimism and sell at the point of maximum optimism. Templeton's career became a study in courage. While other investors stayed confined within the borders of their home countries, he traveled the world, searching for opportunities in emerging markets long before they were fashionable. He invested in Japan when it was still recovering from devastation. He invested in South Korea, Brazil, India, and countless countries that traditional investors considered too risky. He understood that growth often emerges from places overlooked by the rest of the world. While Templeton was redefining global investing, another figure was quietly transforming the world of bonds, a field long considered mundane and predictable. His name was Bill Gross, and he would eventually earn the title the Bond King. Gross recognized that bonds, though less glamorous than stocks, were essential to the financial system. He believed that with discipline, analysis, and a deep understanding of macroeconomic trends, bonds could generate exceptional returns. Gross built his empire through an obsession with detail. He studied interest rates, inflation trends, monetary policy, and global debt cycles with almost surgical precision. While others treated bonds as safe, low-yield assets, Gross saw patterns and opportunities invisible to most. He pioneered the concept of active bond management, demonstrating that fixed-income investments could be just as dynamic, strategic, and profitable as equities. His influence grew so large that central banks, governments, and global markets paid close attention to his opinions. A single comment from Gross could shift billions of dollars around the world. His success helped build PIMCO into one of the largest asset managers on the planet. His legacy remains an essential chapter in the evolution of modern finance. As these investors were transforming their respective domains, the world stood on the edge of a new technological revolution. Markets were no longer driven solely by intuition and experience. Data and computational power were beginning to enter the scene, and among the pioneers of this new age stood another remarkable figure, Peter Lynch. Lynch became famous for his management of the Magellan Fund, a portfolio that grew from a small institutional product into one of the most successful mutual funds in history. What made Lynch exceptional was his ability to blend quantitative analysis with a deeply intuitive understanding of consumer behavior. He believed that ordinary people often spotted trends long before Wall Street did. If shoppers were filling their carts with a particular product, or if a brand was suddenly becoming popular among teenagers, Lynch saw that as a clue, evidence of growth before the financial data caught up. He called this strategy, invest in what you know. For Lynch, the stock market was not an abstract machine. It was a reflection of daily life. He studied newspapers, visited stores, talked to employees, and paid attention to cultural trends. His approach resonated deeply with millions of individual investors, making him not only a successful fund manager, but also a teacher whose lessons empowered everyday people to participate in the market. His returns were extraordinary. Under Lynch's leadership, the Magellan Fund averaged annual returns that became the envy of the financial world. But perhaps more important than his performance was his philosophy, one that encouraged curiosity, research, and a belief that opportunity was everywhere, hidden in plain sight. By the time Lynch retired, he had become a legend. His writings would inspire generations of investors, shaping the thinking of amateurs and professionals alike. In his view, investing was not merely a profession. It was a way of understanding the world. As Part 2 closes, the landscape of investing has transformed dramatically. The thinkers of this era did more than earn fortunes. They rewrote the rules, reinvented strategies, and expanded the boundaries of possibility. They turned investing into a global, accessible, and intellectually rich field. Their ideas became the foundation upon which future generations would build. In the next chapter, the narrative shifts once more to investors who pushed the boundaries even further, embracing technology, risk, globalization, and sometimes controversy. Their stories reveal the high-stakes world of hedge funds, macro strategies, and the relentless pursuit of performance in markets that never sleep. As the world moved deeper into the 20th century, the landscape of global finance began to transform at breathtaking speed. New technologies reshaped entire industries, capital markets expanded across continents, and geopolitical tensions disrupted the old order. In this changing environment, a new generation of investors emerged, individuals who understood not only how markets worked, but why human nature so often worked against them. These investors were not ordinary participants in the economic system. They were architects of strategies, interpreters of cycles, and in many cases, pioneers who rewrote the rules of modern investing. Among them stood a man whose name became synonymous with long-term thinking and unwavering discipline, Peter Lynch. Lynch's rise occurred at a time when many investors were dazzled by short-term profits and speculative manias. But Lynch viewed the stock market through a simpler and more human lens. He believed that ordinary people, equipped with curiosity and basic financial knowledge, could outperform professionals. His philosophy centered on the idea that great investment opportunities often begin on the street, in stores and products people use daily. He encouraged investors to buy what you know, not as a slogan, but as a method of approaching the market with intuition and research instead of blind speculation. Running the Magellan Fund at Fidelity, Lynch produced one of the greatest track records in mutual fund history. His returns were so extraordinary that they almost seem unreal, yet they were achieved through relentless research, deep conviction, and an ability to see value where others saw routine. Lynch traveled constantly, visiting hundreds of companies each year, meeting executives, analyzing operations, and looking for what he called 10-baggers, stocks capable of rising tenfold. His genius lay not in predicting markets, but in recognizing overlooked potential and pairing it with patience. Under Lynch's stewardship, the Magellan Fund grew from a modest pool of assets to a giant, returning an average unmatched by most investors before or since. He became a symbol of democratic investing, proving that success in markets was not reserved for the elite or the secretive few. Around the same era, another investor was carving his place into history through a radically different approach, an approach built on mathematics, statistics, and the emerging power of computers. Jim Simons, a brilliant mathematician and former codebreaker, entered the financial world not through tradition, but through curiosity. He wondered whether patterns within markets, patterns too subtle for human intuition, could be deciphered with algorithms. His firm, Renaissance Technologies, became the laboratory where this idea evolved into a financial revolution. Using quantitative models, sophisticated systems, and thousands of lines of code, Simons developed strategies that extracted small inefficiencies from markets again and again with astonishing consistency. What made Simons remarkable was not just his returns, which surpassed even the most legendary investors, but the fact that he rarely spoke publicly about his methods. His success came not from instinct or speculation, but from rigor, data, and a willingness to abandon human emotion in decision-making. Renaissance Technologies operated like a secret scientific institution rather than a traditional investment firm. Its flagship Medallion Fund became so successful that it eventually closed to outside investors, returning profits only to employees. Simons reshaped modern finance, proving that markets could be understood through formulas, and that the future of investing would belong increasingly to those who mastered data. His legacy stands at the intersection of mathematics and financial innovation, influencing countless hedge funds and quantitative models that followed. But not all investment legends came from academic backgrounds or extraordinary intellectual gifts. Some rose through instinct, grit, and an unusual understanding of human behavior. One such figure was Jesse Livermore, often called the boy plunger, for his fearless trading in early 20th century markets. Livermore was a speculator in the purest sense, operating at a time when markets were chaotic, lightly regulated, and heavily influenced by emotion. From bucket shops to Wall Street, he built his fortune by mastering the art of reading price movements, sensing market psychology, and acting when others hesitated. Livermore understood cycles of greed and fear better than almost any investor of his time. He learned that markets move not only because of economic fundamentals, but because of the collective behavior of millions of people. His trading rules, cut losses quickly, let winners run, avoid overtrading, became timeless principles repeated by generations of professionals. Yet Livermore's life was also a dramatic lesson in the dangers of leverage, impulse, and emotional strain. He built and lost multiple fortunes, leaving behind a dual legacy, brilliant insights into speculation, and sobering lessons about the psychological weight of risk. His story personifies the intense human drama embedded within financial history. As markets continued to evolve, a quieter figure emerged, one whose contributions shaped the very structure of modern investing. John Bogle, founder of Vanguard, was not concerned with beating the market. Instead, he asked a revolutionary question. What if ordinary investors could capture the market's long-term growth without paying high fees, without chasing trends, and without taking unnecessary risks? This question led to the creation of the world's first index fund. Bogle became a champion of low-cost, passive investing, arguing that investors should minimize expenses and seek steady compounding over time. His philosophy challenged Wall Street's culture of active management and speculation. Many professionals mock the idea of indexing, but Bogle's vision proved to be one of the most transformative innovations in financial history. Today, trillions of dollars are invested in index funds worldwide, empowering individuals to build wealth efficiently and transparently. Bogle's contribution lies not only in financial theory, but in democratizing investing, making it accessible, affordable, and sustainable for people around the world. While Bogle was reshaping investment vehicles, another visionary, Benjamin Graham, continued influencing generations with his philosophy of value investing. Graham's teachings on margin of safety, intrinsic value, and disciplined analysis became the foundation upon which countless investors, including Warren Buffett, built their careers. Graham showed that investing was not gambling or speculation, but a thoughtful process rooted in logic and evidence. His work provided the intellectual backbone of modern fundamental analysis. Yet the history of great investors is not confined to America. Around the world, bold thinkers were redefining the relationship between capital and opportunity. In Japan, Masayoshi Son built SoftBank into a global powerhouse by focusing on technology's exponential potential. Son's approach involved big visions, high conviction, and a willingness to place monumental bets on emerging trends. Some investments soared, others struggled, but Son's boldness made him one of the most influential figures in venture capital, a field defined by uncertainty and outsized rewards. In Britain, John Templeton became known for finding value where others saw hopelessness. Templeton built his fortune by buying stocks in markets suffering from fear, war, or crisis. His philosophy was global, diversified, and rooted in the belief that opportunities exist everywhere, especially where pessimism is greatest. Templeton's approach required emotional strength and a contrarian mindset, enabling him to identify bargains in ignored markets long before international investing became common. As the 20th century approached its end and the digital era began, the role of investors expanded. They were no longer merely stock pickers or speculators. They became builders of industries, catalysts for innovation, and architects of new economic ecosystems. Venture capitalists like Sequoia, Capital Umke S. Don Valentine and Andreessen Horowitz S. Mark Andreessen recognized the transformative power of technology long before it became obvious. They provided early support to companies that would redefine commerce, communication, and society. Their ability to see potential in ideas that seem futuristic or uncertain changed the trajectory of Silicon Valley and influenced technology markets worldwide. The investors of this era shared a common trait, a unique lens through which they viewed risk, opportunity, and the future. Whether through deep fundamental analysis, mathematical precision, contrarian instinct, long-term discipline, or visionary conviction, each contributed to the evolution of modern finance. Their stories reflect not just financial brilliance, but resilience, curiosity, and the courage to challenge assumptions. As global markets grew increasingly interconnected, these investors laid the foundation for a new age, an age where knowledge, innovation, and strategy would matter more than ever. Their lessons continue to shape how the world thinks about wealth, risk, and possibility. And as the documentary prepares to move forward into the next chapter, the stage is set for exploring how these insights influence the modern investing landscape. A landscape defined by unprecedented complexity, rapid technological change, and new pioneers pushing the boundaries of what is possible. As the world moved deeper into the second half of the 20th century, finance entered a new age, an age shaped not just by intuition or tradition, but by the relentless search for patterns hidden beneath the surface of markets. The rules of investing were evolving, and the next generation of great investors would combine innovation, discipline, and a willingness to challenge long-held beliefs. Among them were pioneers who saw the market not as chaos, but as a system waiting to be understood with the right tools, the right mindset, and the courage to move against the tide. One of the most influential figures of this era was Jack Bogle, a man whose mission was not merely to beat the market, but to transform how ordinary people participated in it. His philosophy was deceptively simple. Most investors fail to outperform the market, and the best long-term strategy is to invest in the market itself at the lowest possible cost. Bogle believed that high fees, rapid trading, and speculative behavior were destroying wealth for millions. His response was revolutionary, the creation of the index fund. When the first index fund launched, it was mocked, ignored, and even ridiculed. Critics called it un-American, a loser's investment, and something no serious investor would touch. But Bogle had something more powerful than approval. He had data. He understood that market returns, compounded over decades, would outperform the vast majority of actively managed strategies. Slowly, his idea gained momentum. What began as a controversial experiment grew into a global movement that empowered millions of everyday investors. Bogle became known as the champion of the individual saver, a man who democratized investing by stripping away unnecessary complexity and putting the power of compounding into the hands of the ordinary citizen. While Bogle reshaped investing for the masses, another figure was taking a very different approach, one rooted in speed, mathematics, and the ability to exploit inefficiencies before anyone else even knew they were there. Jim Simons, the mathematician who founded Renaissance Technologies, did not come from the traditional world of Wall Street. He came from academia, from a world of equations, algorithms, and intellectual curiosity. Where others saw randomness, Simons saw patterns that could be detected, measured, and acted upon. His firm would become the birthplace of quantitative investing. trading strategies driven not by human emotion or intuition, but by computational models that processed vast amounts of data. Simons recruited physicists, mathematicians, and scientists who had no experience with finance. Their mission was simple in theory, yet overwhelmingly difficult in practice: identify repeatable signals in market behavior and exploit them with precision and consistency. The result was the Medallion Fund, one of the most successful investment vehicles in history, producing returns so extraordinary that they defied conventional belief. Rentec became known not for interviews or publicity. They rarely spoke at all, but for results. And behind those results stood Simons, a quiet revolutionary who had rewritten the definition of what it meant to be an investor. As Simons' machines uncovered hidden opportunities in the markets, another investor was rising through the ranks by blending macroeconomic intuition with geopolitical awareness. This was Ray Dalio, the founder of Bridgewater Associates, whose philosophy rested on understanding how economies actually work. Dalio built systems that mapped the cause and effect cycles of markets, how debt expands and contracts, how central banks influence liquidity, how human psychology alternates between fear and greed. Dalio's approach was grounded in radical transparency, both within Bridgewater and in his own thinking. He believed that the key to long-term success was understanding how decisions were made, why mistakes happened, and how to refine systems through honest reflection. His firm grew into one of the largest hedge funds in the world, guided by principles that emphasized clarity, process, and the disciplined handling of risk. Dalio's ability to navigate global crises, from inflationary shocks to financial meltdowns, made him one of the most respected macro thinkers of his generation. While Dalio and Simons reshaped institutional investing, another pioneer was transforming venture capitalism and the world of early-stage innovation. Peter Thiel, co-founder of PayPal and one of Silicon Valley's most influential investors, understood that the greatest returns come from the rare companies capable of creating entirely new markets. Thiel believed in identifying ideas that seemed improbable, founders who could see what others couldn't, and technologies that had the potential to reshape the world. He famously invested in Facebook when it was just a startup, a decision that would become one of the most lucrative in venture capital history. His philosophy centered on the belief that truly exceptional companies, those capable of achieving monopoly-like dominance, are the engines of long-term value creation. At the same time, another figure was emerging in Silicon Valley, someone whose intuition, creativity, and eye for transformative potential reshaped the startup ecosystem. Marc Andreessen, co-creator of the early web browser and co-founder of Andreessen Horowitz, believed that software was not merely a tool, but a force that would swallow entire industries. His firm bet on companies that embodied this idea, Facebook, Airbnb, Coinbase, Slack, and became one of the most influential voices in the digital economy. Andreessen's famous declaration that software is eating the world became a guiding philosophy for investors seeking to understand the direction of the modern economy. As venture capital reshaped technology, another type of investor was proving that patience, discipline, and long-term thinking could thrive, even in an age of rapid transformation. Howard Marks, founder of Oaktree Capital, built his reputation not on speculation, but on understanding cycles of risk and opportunity. Marks specialized in distressed debt, buying assets when fear dominated and prices collapsed. His memos, written with clarity and humility, became essential reading for investors worldwide. He reminded them that success was not about predicting the future, but about recognizing when markets were mispricing reality. His philosophy emphasized that risk is not something to avoid, it is something to understand. As investing philosophies diversified, the landscape of global markets became increasingly interconnected. Economic cycles in one region could ripple across continents. Investors who understood this new reality rose to prominence. Among them was Stanley Druckenmiller, a master of macro trading whose ability to anticipate major economic movements became the stuff of legend. He famously predicted the fall of the British pound under George Soros, generating one of the most profitable trades in history. Druckenmiller believed in conviction. When the odds were in his favor, he wasn't afraid to bet big. His career became a testament to the power of deep analysis, rapid decision-making, and the willingness to act decisively when the world hesitated. All these investors, Bogle, Simons, Dalio, Thiel, Andreessen, Marks, Druckenmiller, contributed to an investment universe far more diverse than the one that existed just a few decades earlier. Each represented a different philosophy, from indexing to quant trading, from macro strategies to venture capital. Together, they shaped the modern financial world and inspired generations of investors who would follow. But the story of great investors was not finished. The world was entering an era defined by digital transformation, decentralized technology, and global interdependence. New challenges awaited, and new visionaries would soon emerge to tackle them. The documentary now approaches the closing chapters, where the next generation of investors rise, and where the lessons of the past illuminate the path forward. As financial markets entered the late 20th and early 21st centuries, a new breed of investor emerged, individuals who not only mastered the old rules of capital but rewrote them entirely. Their stories unfold across trading floors buzzing with energy, in quiet offices illuminated by screens, and in boardrooms where decisions shape the future of entire industries. These investors were not simply chasing fortunes. They were chasing insight, clarity, and the elusive patterns hidden within the noise of the world's economies. Among them stands Ray Dalio, the visionary behind Bridgewater Associates, a titan who approached markets not as chaotic battlegrounds, but as systems governed by cause and effect. Dalio's genius was not rooted in instinct, but in principles, clear, measurable, testable frameworks through which he filtered every decision. As markets fluctuated and crises appeared, his algorithms and models turned economic behavior into patterns that could be understood and predicted. But Dalio's real contribution was his philosophy. He built a culture of radical transparency, where even junior employees could question leadership, and where mistakes were not hidden but analyzed openly. This culture allowed Bridgewater to avoid many of the emotional traps that derailed other investors. During the financial turmoil of 2008, while institutions collapsed under the weight of risky positions, Bridgewater's strategy positioned it for enormous gains. Dalio proved that disciplined thinking and unemotional analysis could triumph even in markets consumed by fear. And yet, Dalio was not alone in transforming how the world invests. Another towering figure rose from Japan, Masayoshi Son, the founder of SoftBank. His style could not have been more different from Dalio's. Where Dalio prized caution and logic, Son pursued bold visions and unprecedented risks. He placed colossal bets on emerging technologies long before they became global disruptors. His investment in Alibaba, made when the company was barely known outside China, became one of the most profitable investments in history. Son's belief in a future shaped by information, artificial intelligence, and connectivity fueled his aggressive approach, turning him into one of the most influential and daring investors on the planet. As these new giants rose, markets themselves were changing. Technology accelerated information flow. Globalization connected economies previously isolated. Capital surged across borders with unprecedented speed. The world needed investors capable of navigating this new terrain, and few embodied this evolution as powerfully as Peter Lynch, the legendary manager of the Magellan Fund. Lynch was the master of simplicity. His mantra, invest in what you know, redefined the relationship between everyday experience and financial success. He believed that walking through a mall and observing which stores were full could yield insights more powerful than complex financial models. Lynch hunted for 10-baggers, companies capable of growing tenfold, and he found them in places ordinary investors overlooked. His ability to combine fundamental research with common sense propelled Magellan to extraordinary returns and turned him into a legend for an entire generation of retail investors. But the market was also shaped by quieter, long-term thinkers, investors whose approach relied on patience, discipline, and a deep belief in innovation. One such figure was Philip Fisher. Before growth investing became a mainstream strategy, Fisher understood that the most valuable companies were those with room to expand, innovate, and compound earnings over decades. He interviewed employees, suppliers, and competitors, seeking not just numbers, but business culture, management quality, and long-term strategy. His philosophy deeply influenced Warren Buffett, who credited Fisher's ideas as essential to developing Berkshire Hathaway's investment style. The influence of global economic shifts became increasingly significant, leading to the rise of investors who operated not only across sectors, but across continents. John Templeton stands as one of the greatest examples of this global vision. At a time when most investors focused on their home markets, Templeton searched the world for opportunities others ignored. During periods of conflict, economic uncertainty, and pessimism, Templeton invested boldly, reasoning that fear often created extraordinary bargains. His approach during World War II, when he purchased shares in hundreds of companies many believed would fail, produced remarkable returns. Templeton proved that courage, humility, and a willingness to explore the unknown could yield exceptional investment results. Another monumental force emerged in the realm of quantitative investing. Jim Simons, the mathematician turned hedge fund manager, whose medallion fund became the most successful in history. Simons did not analyze companies, earnings, or economies. Instead, he recruited scientists, physicists, and mathematicians to uncover deep statistical relationships within price movements, patterns invisible to ordinary analysis. The result was a fund that delivered returns so extraordinary they became the stuff of myth. By transforming investing into a scientific pursuit, Simons reshaped the landscape of modern finance and proved that markets, though complex, contain hidden order. As investors like Simons explored the structure of markets through data, others reshaped industries through insight and leadership. Kenneth Griffin, founder of Citadel, began trading from his dorm room at Harvard. guided by an early understanding of how information and speed would redefine modern investing. Griffin built one of the world's most influential hedge funds, an institution driven by elite research, high-frequency execution, and an ability to navigate crises with remarkable precision. During the 2008 financial meltdown, Citadel endured enormous challenges but emerged stronger, reinforcing Griffin's reputation as a resilient and adaptable market strategist. Meanwhile, long-term visionaries like John Bogle focused not on beating the market but on democratizing it. Bogle's creation of the first index fund revolutionized investing by allowing everyday people to access broad market returns at extremely low cost. His philosophy, that most professional managers fail to outperform the market over time, challenged the industry and shifted trillions of dollars into passive strategies. Today, Bogle is remembered not just as an investor, but as a champion of the average person, someone who fundamentally changed the relationship between the public and financial markets. Yet for all their differences, these investors share a common thread. Each saw what others could not. They recognize patterns, opportunities, and truths hidden within the world's economic fabric. Their stories demonstrate that investing is not merely about money. It is about understanding people, innovation, risk, psychology, and the forces that move societies forward. As markets evolved, the stage widened again. A new generation emerged. Figures like Cathie Wood, who embraced disruptive innovation as the foundation of investment strategy. Believing that fields such as genomic medicine, robotics, artificial intelligence, and energy storage would transform global economies, she bet heavily on companies shaping the future. While her approach attracted both admiration and criticism, it highlighted a timeless truth. Every generation of great investors challenges the assumptions of the one before it. This period also highlighted the importance of resilience, patience, and adaptability. Investors witnessed bubbles rise and collapse, technologies advance and fade, industries thrive and decline. Those who endured did so not through luck, but through clarity. Clarity in purpose, clarity in method, and clarity in belief. Part 5 captures the transition from traditional investing to the dynamic, technology-driven landscape that defines modern finance. From disciplined systems thinkers to brave visionaries, from global strategists to champions of ordinary investors, these individuals expanded the very definition of what it means to invest. Their legacy would pave the way for the final evolution, a deeper exploration into how these strategies, philosophies, and breakthroughs shape the world we live in today and how they continue to define the next era of financial history. As the world enters the 21st century, the landscape of investing transforms once again. Technology reshapes how markets move, how information flows, and how decisions are made. Yet, amid this rapid change, the timeless lessons of the greatest investors continue to echo, reminding new generations that behind every chart, every trend, every economic cycle lies human psychology, discipline, and the persistent search for value and meaning. In this final chapter, we explore not just the later giants of investing, but also the evolving philosophy that connects them across decades. The investors who thrive in modern markets do not merely ride technological waves, they interpret them. They understand that innovation creates opportunity, but wisdom determines survival. From the rise of index funds to the explosive growth of venture capital, from the dot-com bubble to global financial crises, the story of modern investing becomes a mirror of human ambition. The era begins with the revolution sparked by John C. Bogle. His relentless belief that most investors would be better served by owning the entire market, rather than guessing its movements, changes everything. The creation of the first index fund is mocked, dismissed, and even labeled Bogle's folly. Yet Bogle remains unwavering. He understands that minimizing costs, embracing long-term compounding, and eliminating emotional trading can create extraordinary wealth for ordinary people. Over decades, his philosophy proves right. Index funds grow from a fringe concept to a foundational pillar of modern investing. Bogle becomes not only a financial pioneer, but a champion for everyday investors, reshaping the world of finance with quiet perseverance. At the same time, other investors explore new frontiers, territories once considered too speculative or unpredictable. Among them is Peter Lynch, the energetic manager who transforms Fidelity's Magellan Fund into a powerhouse of performance. Lynch's secret is disarmingly simple. Invest in what you understand. By walking through shopping malls, studying consumer behavior, and analyzing the products people love, he discovers opportunities hidden in plain sight. Lynch teaches millions that extraordinary returns do not require complex formulas, only curiosity, discipline, and the courage to trust one's own eyes. His phrase, "buy what you know," becomes a mantra for a generation seeking clarity amid the noise of financial markets. Yet the modern world is not defined only by stock markets. Venture capital emerges as a new arena where visionaries gamble not on established companies, but on bold ideas, untested technologies, and the potential to reshape civilization itself. In Silicon Valley, a different kind of investor rises, part strategist, part mentor, part risk taker. Figures like Don Valentine, Michael Moritz, and Mark Andreessen become architects of the technological revolution. They invest in companies before the world understands their value. They nurture founders, embrace failure as part of the path, and accept that the biggest rewards often come from the boldest risks. Through their guidance, companies like Apple, Google, PayPal, YouTube, and countless others burst into existence, reshaping industries and daily life. The venture capitalist becomes a catalyst, not just a financier. Then comes the dot-com era, a period defined by both the brilliance and the blindness of human nature. As internet companies multiply with incredible speed, investors chase growth with little regard for profitability. Stock prices soar beyond any rational measure, driven by speculation and the belief that technology alone guarantees success. A bubble inflates, built on dreams rather than data. And when it bursts, billions in wealth evaporate almost overnight. Thousands of companies collapse. The world is reminded that markets, no matter how advanced, remain vulnerable to the same fears and manias that have shaped financial cycles for centuries. But from the ashes of failure, new giants emerge. Amazon, Google, and others that survive not by hype, but by building sustainable value. As global markets recover, another towering figure rises to prominence, Ray Dalio. With an analytical mind and a deep fascination with economic patterns, Dalio studies history not as a series of isolated events, but as interconnected cycles. He builds an investment philosophy rooted in radical transparency, diversification, and the belief that understanding cause and effect relationships can make markets predictable. His firm, Bridgewater Associates, becomes the largest hedge fund in the world. Dalio's commitment to principles, more than profit, shapes a new generation of investors who seek clarity amid chaos. But the stability of rising markets is shattered once again in 2008. The global financial crisis exposes the fragility of systems built on debt, risk, and unchecked speculation. As markets plunge, fear spreads across continents. Yet even in these turbulent times, the insights of master investors shine. Figures like Warren Buffett remind the world to remain calm when others panic, buying strong companies at prices that reflect fear rather than reality. Others, like John Paulson, foresee the collapse and take positions that become some of the most profitable trades in history. The crisis becomes both a lesson and a turning point, proof that opportunities often arise during moments of greatest uncertainty. In the years that follow, the investing world expands in new directions. Algorithmic trading, fueled by mathematical modeling and high-speed computing, reshapes market dynamics. Retail investors gain unprecedented access to global markets through digital platforms. New asset classes, cryptocurrencies, decentralized finance, and digital securities challenge traditional notions of value. Yet even as the landscape evolves, the lessons of the past remain relevant. Every bubble resembles the one before it. Every crash reflects a familiar pattern of excess and correction. Every triumph is built on patience, discipline, and an understanding of human behavior. As this documentary reaches its conclusion, one truth becomes clear. The greatest investors of all time are not defined by their wealth, but by their wisdom. They understand that markets are expressions of collective psychology, driven by fear, greed, uncertainty, and hope. They recognize that success requires more than intelligence. It demands humility, curiosity, and the willingness to learn from failure. Their stories transcend numbers. They teach us how to think, how to act, and how to prepare for a future that will always remain uncertain. The history of investing is ultimately a history of humanity. It reflects our dreams of prosperity, our desire to build something greater than ourselves, and our constant struggle to navigate risk in pursuit of reward. As new generations pick up the torch, the legacy of these great investors continues, not as rigid formulas, but as guiding principles illuminating the path toward opportunity, resilience, and long-term success. The final message they offer is timeless. Markets will change, technologies will evolve, but the foundations of great investing endure. Patience, understanding, adaptability, courage, and the commitment to learn, not just from victories, but from the long, winding journey itself.